Hey everyone, this is Kenji from YouTube channel Kenji Explains, and I've partnered with Money Under 30 to create a series of videos. This one's going to be a guide on index funds. So I'll break this video down into four main areas. Firstly, we'll be looking at what is an index fund. Secondly, we'll go over the types of index funds out there. Thirdly, we'll look at how to invest in them. And then lastly, we'll go over the pros and cons of this investing strategy. So firstly, what is an index? And in short, an index is just a measure of something. In finance, indexes are usually used to track the performance of a group of assets. These assets can range from, say, US stocks, which are quite generic, to something more specific like a particular industry group within the stock market, like what could be the tech stocks. So when you hear the news that the market is going up by X% or it's going down by X%, that's actually referring to how a particular index is performing. When looking at the S&P 500 market index, which tracks the performance of the 500 largest companies listed in the US stock exchanges, you'll find a number. As of December 3rd, that number, which is known as the level, is 4,538. You can think of the level as the average price of all 500 stocks. Now on its own, it doesn't really say much, but it does when you compare it over time. So typically when you hear in the news that the market's going up by X amount, that's actually referring to over a specific time period. So for example, it could be how the market's performing today versus yesterday. So if that level's gone up, it's obviously going to be a percentage increase. And you might wonder, how is this level calculated? And it actually depends on the index you're looking at. If we look at the S&P 500, for example, it's a weighted average. So the bigger the market value of a company, also known as the market capitalization, the more weight it's going to have. In this table, you can see the weight breakdown. Microsoft currently has the largest market capitalization, so it gets the biggest weight. And from there, because all the other companies have a smaller market capitalization, they have lower weights. So now that we understand what indexes are, let's look at the types of indexes there are out there. Among the most famous indexes in the US include the S&P 500, which we saw earlier, the Dow, which tracks 30 of the biggest US publicly traded companies, as well as the Nasdaq Composite, which is known to be slightly more tech-oriented. And indexes aren't something exclusive to the US. In the UK, for example, there's the FTSE 100, in Japan there's the Nikkei 225, and if you want to take it even further, there is a world index called the MSCI World Index, tracking stocks across the globe. So we've seen some examples of indexes from all around the world, but there's actually indexes that are specific to a particular industry as well. For example, if you're interested only in tech stocks, there is an index just for that, another one for oil and gas, and so on and so forth. But if that's not enough options, there's even indexes that are not related to stocks. For example, there's a bond index, there's a commodities index, currency index, and so on. So now that you've seen the types of indexes that are out there, you're probably wondering how you can invest in them. So let's look into that. But here's the thing, you can't actually invest in an index. On its own, an index is merely a benchmark that you look at to measure something. So there's no investment in it. But there are two main ways that you can replicate the performance of an index. One of which is an index fund, and number two is an ETF, which is short for an exchange traded fund. Both have the same goal, which is to replicate the performance of an index. That said, they do have some differences between them. The main difference is how they trade. For ETFs, similar to stocks, you can buy and sell them throughout the market open times. On the other hand, for index funds, you can only buy and sell them once the market is closed, so at the end of the trading day. Some of the other differences include taxes as well as the fees involved in them, but those are really on a case-by-case basis, so I suggest you do your own research before you jump for one or the other. And this table here shows the returns of Vanguard's 500 index fund versus the S&P 500 index that is tracking. As you can see, the returns are pretty much the same, just slightly inferior on the whole because of the fees that are paid to the index fund managers. Similarly, if we compare the performance of Vanguard S&P 500 ETF versus the S&P 500 index, you can see that it only differs by a couple decimals. And comparing the ETF versus the index fund performance, you can see that they're pretty much the same. Now, most big brokers out there will have both the choice of an index fund or an ETF, depending on what you prefer. Some of the big name brokers out there include Charles Schwab, Vanguard, which we saw earlier, as well as Fidelity. To illustrate what it actually looks like, here's Fidelity's website with some of the index funds you can buy. As you can see, they've got plenty of options from domestic equities, which basically means US shares, to international markets as well. Looking at the domestic ones, they've got plenty of types within it, like small cap, meaning companies with a small market capitalization or market value, all the way to the biggest out there, which is the 500 one. So let's click on that one. Here you'll find all the relevant information to do with the Fidelity 500 Index Fund, so everything from a summary, you'll see the different details there, the performance, meaning how it's compared to the actual S&P 500 index. Next, you'll have the ratings, so basically what people think of it, After that, you'll have the composition, so what kind of sectors it's currently invested in, as well as its top 10 holdings that you can find here. And then lastly, we'll look at the fees here. So that's basically how much you're paying for this service. And if you're sure that this is what you want and you already have a Fidelity account, you can actually just go ahead and start buying here. Lastly, let's look at some of the pros and cons of index funds / ETFs as an investment. Here's a few of the benefits of investing in index funds or ETFs. The first one has to do with low fees. Because it's regarded as a passive investment strategy, all they have to really do is just copy a benchmark index. So that means that they don't actually need too big of a management team. They don't need a team of people that are going to be thinking of ideas and ways to invest. Instead, all they have to do is replicate the performance of an index. As a result, for us investors, that means that the fees are going to be a lot lower than an actively managed fund, which is going to require a lot of people and a lot of research. As for how low the fees are going to be, that's going to vary, but typically it's around the 0.1% mark or even less depending on the fund. If we look at the fees of the Fidelity 500 index fund that we just saw earlier, going to the fees and distribution tab, you can see that it's even lower than that at 0.015%. Another main reason index funds have become so popular has to do with diversification, which is basically the concept of don't put all your eggs in one basket. Suppose I'm an investor and I put all my money in Apple shares. If Apple does poorly, then I'm probably going to lose all my money. On the other hand, if I buy 4 different shares, say Apple, Google, Facebook, and Microsoft, now if Apple does poorly, hopefully that's only going to be 25% worth of my portfolio going down. Now, if you do that on a bigger scale, like the S&P 500, then you own 500 different companies. Now, the diversification there is a lot stronger. But that said, imagine you had to do that all on your own. You had to buy 500 different companies and determine how much to buy of each. That would be quite messy. That's why something like an index fund, charging a very small fee, can be quite handy for you. Index funds are great, but they're not perfect. Because they replicate the performance of the market, when the market's going down, like say through a financial crisis, obviously your index is going to go down with it. Similarly to that, you'll never actually outperform the market because by definition the goal is to track the market, not to do better than it. That said, many of the actively managed funds out there that try to outperform the market actually end up underperforming in the long run. For example, if we look at this table over here by CNBC comparing the active versus the index fund returns over the past 10 years, you can see that especially when it has to do with US stocks, the performance of an index fund is generally above that of an actively managed fund. Warren Buffett, who's widely regarded as one of the best investors in the world with a net worth of over $100 billion, says investing in index funds is the smartest investment most people can make. That's all for this video. I hope you found it useful. If you did, you can see some of my other videos on my YouTube channel at Kenji Explains, which I'll leave in the description. See you in the next one.